Who's that guy in that old shirt? Who must be the fence expert? Who's that guy in that old shirt? Who must be the fence expert? Time to talk about the fences. It's time to discuss operations and expenses. It's time, it's really time to elevate small businesses. It's time for Joe to drop his knowledge. It's relentless. This rhyme of mine is getting a bit ridiculous. Here we go. We're live with Joe. Enjoy the show.
What is up, everybody? Joe Everest, defense expert, with another incredible interview for you guys covering the wild world of finance, which can be wild and a little bit crazy. So if you guys have watched these episodes before, you know who I'm introducing here or who I'm interviewing here. If you haven't watched my interviews with Andrew, please go back and find those. There's tons of golden nuggets that I have taken out, and I think you would find just as many, if not more. So go back and watch those. But for now, Andrew, for the 2 or 3 people out there that haven't met you yet, maybe a brief introduction.
Sure. So I'm Andrew Martin. I'm founder and president of Atlas Financial Strategies. We're a fee-based business planning and personal financial planning firm headquartered out of Pensacola, Florida, which is in the Panhandle of Florida, sunny Pensacola, Florida. But we work with people all over the United States.
Very good. Very good. So, Andrew, so far we've talked about kind of creating your professional dream team, what that might look like, the professionals you would want to have on your dream team. One of the things that we talked about in the last episode that kind of piqued my interest is talking about life insurance as one of the considerations for putting your whole financial plan or your financial house in order. And I thought it would be worthwhile to separate this into its own episode. One, because when I get into it, I get confused. So I figured there's probably a handful of people out there at least that also get confused when talking about life insurance. Now, before we dive into it, though, I would like you to repeat a formula that you got into the last time when talking about life insurance, so that if someone hasn't watched that episode, they're watching this one, they're finding this one for the first time. I think they would find it worthwhile, or at least educational. Can you walk us through that formula on how to figure out maybe a rough number on how much life insurance you should have?
Yeah, so I'm glad we're doing this because there's so many common misconceptions, so many misunderstandings and things when it comes to life insurance. And there's a lot of agents or advisors out there that are at least part of the reason why there are so many misunderstandings. So yeah, I think one of the things that we take clients through is our financial foundation, which life insurance being part of it. And life insurance is one of the only few insurances that you need to calculate based on your own specific circumstances, right? Instead of I kind of hate the general lazy advice of you need to have X times income, or you need, and most of the time people either don't know what they have, or if they've put any thought into it at all, like if they actually know how much life insurance they have, and if I ask them how much they have, they're like, oh, I got 500,000 or $1 million or whatever the number is. And it's like, all right, well, how did you reach that number? And it's like, sounds like a lot of money. I don't know. So I just want people to be, yeah, I don't know. Sounds like a lot of money. I mean, I couldn't tell you how many times I've heard that, but so I just want people to be intentional and thoughtful and thorough and a little bit more precise when it comes to that, because you don't want to have too much, if there is such a thing, but you also want to make sure you have enough. So I always tell people what's most important about your life insurance is that you have the amount that you need. Type is secondary, because if something were to happen to me and somebody delivered a death claim check to my wife, she is not going to ask if it's term or whole life or universal or any of that stuff. She's going to want to know the number on the check. How much is it, right? So, and probably same is true for most of our spouses, kids, all the things. Yeah. And it would be useful if, for anybody listening, you can get a pen and paper really quick, because this is an easy kind of a back of the napkin way to do this, that are all based on your own specific numbers. So part A, so there's A, B, and C. So if you want to write A, B, and C, part A for your life insurance need calculation is if you were to have to write a check to pay off all the debts that you would want paid off for your surviving spouse and or kids, how much would that be? So typically mortgage is going to be in there. There's might be other things in there, right? So just add up whatever debts that you have, add those up, and that's part A. So for a placeholder, let's say it's $500,000. So $500,000 in part A. Part B is if you were to have to, presumably if you have young kids, we're putting money aside for them for the most part, or we would like to. And that could be for college or Head Start to Life or whatever it might be. But we're usually putting money aside for them for their future, whatever that means for you. So if you're no longer here to work and produce that income, where does the money come from? And so, the life insurance could make the savings for the kids self-completing, so to speak. So if you were to leave an amount of money per child, how much would it be and what would it be for? Now, I will say this is something that a lot of people kind of get caught up on because it's a loaded question. It's number one, we hope it's a moot point. So it just needs to be somewhere between $0 and $1 million, right? So, I mean, I've heard everything. There's not a wrong answer. Hopefully you live to see them grow up, right? And all that stuff. Yeah. But if you're not, how much money do we want to leave per child? So again, I've heard all sorts of things, and there is no wrong answer. But again, for sake of argument, for sake of this example, let's say you have 2 children that you want to leave $100,000 a piece to. So then that in part B, you would write 100,000 times 2 equals 200,000, and that's part B. Part C, if you wanted to replace your income or provide an income for your surviving spouse and or children, what is the annual income that you would like them to get, and then for how long? So again, the example that I use, or the analogy, is, let's say you make $100,000 per year that your family is dependent upon. If you had a machine in your garage that printed $100,000 per year that your family was dependent upon, I'm assuming you would insure that machine, because if it stopped working, y'all are without that $100,000 per year.
For sure.
I'm sure everybody gets the analogy. You are that machine, right? So again, let's say that you make $100,000 per year, or you would like your family to continue to get, $100,000 per year if you're no longer here. Then that's what that would, you put 100,000 and then times however many years. Now, this is the tricky part. And again, there's not necessarily a wrong answer, because if life insurance was free, we'd all have $1 billion of it, but it's not, right? So we got to find that balance. So for the number of years, I've heard everything from 2 to 50, right? So there's no wrong answer. Now, I will say this is something that I really want people to put thought into, because let's say that you're like me and your wife stays home with the kids, which is far more valuable to me, and I think to me and the kids, and to her, I believe, than if she were working. I much prefer her staying home with the kids, and I'm glad that she loves doing it. So I want her to continue to stay home with the kids forever. I just want, especially if I'm not here, and she's I want her to be able to solely focus on the kids and not have to worry about money or any of those things. So, if people are like, 2 years would be fine, they can figure it out after them. My kids are 6 and 10. Well, 2 years didn't do us a whole lot of good. I mean, it's some breathing room, but I hate to say it, she's got to either go back to work and really try to split time between earning money and being there for the kids and all that, which any single parents out there knows how hard that is. Or she has to find my replacement, which she's very beautiful and I'm very replaceable, and I'm sure that she would have no problem doing that, but she would need to, you know what I mean? So, or go back to work. So she's either got to find a sugar daddy or something, or she's got to, got to go back to work. So I would like her to continue to stay home at least until the kids are out of school. So when I first got the life insurance, that was, at least 20 years out or so. But thinking ahead, if, that happened 20 years, the money dries up, all those things. Well, now she's in her 50s in 20 years and has to go back to work, been out of the workforce for 30 years. So she's not going to get the job that she was once qualified for. And she's got to start saving for her own retirement starting in her 50s. Not exactly the position of power I put her in. Or she kind of sees the writing on the wall, understands what awaits for her, goes back to work before the kids are out of the house, and then I didn't accomplish what I said I'd accomplish. So ideally, I have enough money to pay debts, leave money to kids, and provide her with an income for potentially the next 60-ish years. That puts her in her 90s, right? Yeah. So now, again, that's me, and that's what I want, or whatever. So again, just for sake of this example, I just want people to really put some thought into, all right, when this money dries up, let's say I replaced it for 2 years or 5 or 10 or 20 or whatever the number is, what happens then? Just think, try to think as long-term as you can. So for sake of part C, if you wanted to replace $100,000 per year times, let's say 20 years, 100,000 times 20, that's $2 million for part C. So for this example, we have 500,000 in part A, which is to pay debts, 200,000 in part B, which is 100,000 times 2 children, and then 2 million for part C, which is 100,000 times 20 years. So that means the life insurance need for the person in this specific example is 2.7 million, 2,700,000. Now, again, that's the life insurance need, whether that is the amount that you choose to actually purchase or not, right? That's up to you. Now, another kind of take on that is I have a couple $1,000,000 worth of life insurance on my wife as well. And again, she stays home. So it's a little bit of a harder calculation for a stay-at-home spouse because I'm not out of an income if something were to happen to her. But two things. Number one, if I had to pay somebody to do all the things that she does, it's going to cost me a lot of money. And then two, I'm going to be working less and have a loss of income because I'm the single parent now and I got to get them to school, home from school, sick days, holidays, all the stuff after school, just all the stuff. So I'm going to be working less, which means less income for me. So that's kind of the double whammy of increased expenses and less income, right? So that couple million, again, a little bit harder of a calculation on a stay-at-home spouse, but still, just because they don't earn an income. And listen, I hear it from a lot of guys say, and even if the wife is working, but let's say that she doesn't make as much as he does in this example, I hear a lot of guys be like, oh, I'm going to be fine without her income. And I'm like, well, all right, man, but you're thinking the way you're thinking, and I can speak for myself. I can't speak for all of us husbands.
Sure.
But the way he's thinking about it is the way his life is now, which, let's be real, your wife is probably doing 90% of the kid and home stuff, even if she's working. She's probably doing the majority of it. So you're thinking like, yeah, apply for it to stay the same. I could do without this X amount of dollars per year and I would be fine. Like, okay, but number one, why is she working if you could do without it?
Right.
Number two, you're going to be stretched really thin, man. I don't know if you know how much that she does with the kids in the home and just all the other things, right? Like you're going to have to hire a nanny or something. Like you just, it's just going to be, life is going to be different. So, I know we all have the S on our chest and we're Superman and we can do everything, but let's be real, right? Maybe we can't. So again, I just think that's a pretty easy back of the napkin way for people to kind of walk through with their own numbers, how much life insurance they believe they need based on that kind of simple-ish calculation. And again, I will say for business owners, there are two different sides of the life insurance need calculation. There's the personal side, which is what we went through. And then there's the business needs, right? Which could be two things. One would be for like a succession planning, right? Like if you have a partner or if you have like an heir apparent, a successor that you plan to purchase the business from you upon your passing or at some point in the future, whatever. Or a partner that, of course, would purchase your shares ideally. So that kind of brings me, we could have a whole conversation, not today, I guess, but about the need for succession planning and buy-sell arrangement and all the stuff. Super important and almost never done. But anyway, so you might need some from a succession planning standpoint. And then if you're like most business owners, the business is still pretty dependent upon us, right? So you're probably also a key person within the business as well. So in other words, if you were to go, somebody has to pick up your productivity. Somebody has to pick up the slack of the loss of your productivity within the business, right? So, and that's true with you and any key person. So there's going to be a gap or a hole left in the business that the business is going to need an influx of cash to help find, hire, and train your replacement or replacements, because it's probably going to take a couple people to do what you do within the business.
Absolutely.
And then there's going to be a need for some cash to help with that, whatever loss of productivity that the business would realize in that person's absence until you get, somebody up to speed. So that's the amount, which is most important. That's the way to calculate the amount. And then from there, you go on to type. But again, you need to have the amount that you need to have first. Type is second.
Yeah. You've got to know what you're shopping for, or what number you're shopping for, before you can get into which avenue you're going to go down. Now, Andrew, this seems like a good place to pause and say, we are not giving specific advice to anyone out there that's listening or watching, right? So you would want to take this conversation whet your appetite a little bit so that you can walk into a professional's office and speak knowledgeably about what you think you want or you think you need, but lay out your situation to that professional and let them ultimately make the decision on which one, maybe a combination, that sort of thing is best for your specific situation. Does that sound right?
Yeah. Yeah. And use somebody you trust, and look, use somebody you know and trust, because, I hear all that, and I get, and it's a tough kind of a dance, when you're talking to people about life insurance, because it is a commissionable product, right? So if somebody helps you with a life insurance application and the policy and whatever, that person's going to get paid a commission from the insurance company to help you with that product. So that's that kind of, there's always that little bit of uneasiness, I feel like, all right, well, do I need, again, in this example, that $2.7 million worth of life insurance, or is this person just trying to sell me a big life insurance policy or whatever? So if you have the thought of, is this person just trying to sell me a life insurance policy, it's obvious that maybe you don't trust them fully, and I just encourage you to find somebody that you trust, or go in knowing what you need and saying, hey man, this is what I'm going to get. So, let's just, can you help me with it?
Right.
Let's do the paperwork. Let's get it done. But
yeah, and here's the types I think I need. Right. And that sort of thing.
Right.
So that, because that's my very limited understanding, is some of the types pay differently, and it probably depends on who's covering it and all that, but different types may pay the professional a little bit differently as well. Is that right?
That is true. So a couple things. What people don't necessarily understand about life insurance when it comes to the insurance companies is a lot of the insurance companies actually make a lot of their money on the term policies, not the whole life or universal policies. Not saying that they don't make good money on those,
Sure.
but term, because statistically speaking, most terms never pay out, right? And so we can define those and everything else, but also the insurance agent or the advisor or what have you, most of the time they're getting paid on premium. So in other words, they're getting paid a percentage of whatever your premium is. So in other words, if your premium is $1,000 a year or $10,000 a year or whatever, they're generally getting paid a percentage of that annualized premium. So a lot of times it is in the agent or advisor's, let's say, their best interest. They're more motivated to sell you something with a higher premium because that's how they get paid. That's how that's how they get paid. So sometimes I find that agents or advisors are trying to fit a square peg in a round hole, so to speak, where they're trying to talk to this person about doing a whole life policy or a indexed universal life policy or whatever, and just talking about how amazing these things are. And I'm not saying that those things aren't great. I'm not saying that.
Yeah.
But we had 2 doctor clients come to us, and they had been working with an agent, like an insurance agent advisor person. And they were like, look, we're not against whole life or annuities or any of those things, but we just find it hard to believe that like those 2 things are the answers to all of our financial woes.
Sure.
And I was like, yeah, that's probably not the case. And they were like, so we just want some good, thorough, unbiased advice. And I was like, well, look, we can do that because the way we work, we charge a fee for our time and whatever. And so it doesn't matter to us, right? But it is part of our process to talk to clients about insurances as part of, as well as all sorts of stuff. But I said, look, just so you know that there's not, any sort of like conflict of interest, or I'm not trying to sell you a policy or anything. Like if we talk to you about things like life insurance, and let's say that we decide that you need more life insurance, like go get it through that person, right? So like we're not getting any commission on it. The advice is the same. It doesn't matter to us. So with their situation, they ended up needing, more life insurance. And I said, look, call, your lady and get it through her and, whatever. And so that was a nice, kind of workaround. It made them feel comfortable and all that. So again, doesn't matter to us, but point is you need to work with, I just use that story as an example because I think that is so common of an experience for people who, are maybe used to working with or have any sort of experience working with an advisor or agent or whatever, that they feel like they're getting sold something. So work with somebody you know and trust. If you feel like they are trying to sell you something, they might be, or it just could be your misconception, right? Because maybe you just actually do need more life insurance. But if you feel that twinge of like, maybe I'm not sure if I trust the advice or not, then maybe, find somebody else to work with, or go in knowing exactly what you need and just don't take their advice and have them be an order taker, for lack of a way to put it.
It makes sense. So, and that's kind of what we're trying to do today, right? Is trying to at least lead people down a path, right? To say, hey, these are probably what you should ask for, and that sort of thing. So you mentioned 3 different types: term, whole life, and universal. And those are those kind of the big 3 or the main 3?
Yeah. So, I mean, there's subcategories under those, but those are kind of the big 3 categories, if you will. So, and I think it's really important for people to understand at least, kind of like you said earlier, from like a, 30,000 foot view, to at least understand at least basic differences. So I'll try to explain it in a way that is easy to understand and a little bit into the weeds, but hopefully not too much. So,
and maybe
I want to be thorough, but not.
Absolutely. And maybe we talk about a little like pros and cons, a few pros, a few cons, and maybe some generic use cases. So someone can try to understand if for their particular, are we talking about something that they might want to have a conversation with a professional about?
Yep. So I will say most of the time we encourage clients to at least start with term. So term is going to be the cheapest way to go. And, granted, it is temporary, let's say, but again, what's most important is that you have the amount. So let's apply for the term. Let's get you as much, or, let's get you the amount that you need. And then, from there, we can always convert that term into something permanent, depending on what company it's through and what exact product or whatever. So, make sure that you talk to somebody to make sure you have a term that is able to convert into something permanent at some point down the road. And again, you may never use that, but I will say from our experience, it is a very nice thing to have, because if and when you choose to turn that term into something permanent, generally speaking, you're able to do that at that same rating that you have now, even if you're uninsurable. So in other words, let's say you went through underwriting on a term policy. I'm freezing. Is that me again? Am I freezing up?
Yeah.
Oh, man. All right.
I'm trying to think about where it froze. So maybe we back up to term, and because we had started getting into convert, or maybe if there's a natural starting point about talking about terms that can convert to from there.
Yep. All right. I think I'm freezing up every now and then. So yeah, you want to make sure, if you, generally speaking, that you're able to get one that you're able to convert into something permanent down the road.
Okay.
And generally speaking, when you do that, you're able to convert it at the same rating that you have now, even if you're uninsurable. So in other words, let's say you went through the underwriting for a term policy, you got a preferred rating, which is, generally speaking, a good rating. And let's say 5-10 years from now, it made sense for you to convert that into something permanent. But let's say for whatever reason, your health has changed and you would either get rated. So in other words, you'd have a way worse rating, or let's say you're uninsurable altogether. You have cancer, or you have some sort of, whatever it is. You would still be able to convert that at that preferred rating, even though you are uninsurable. So that's a nice benefit to have. And I will say the way we think about things now versus how we might think about things in the future are different. As we've probably seen just in our own lives over the last 5, 10, 20 years, right? I'm sure whatever it is that we thought 10, 20 years ago is wildly different than the way we see things today. or at least somewhat. So term is temporary. So you're basically renting it for a specific period of time. So in other words, think about like if you are renting your home and you work to deal with the landlord to say, hey, look, I just want the price to be the same for 20 years and I want to be guaranteed that I can live here for 20 years.
Sure.
So I'm just going to lock in this price for a 20-year period of time. That's a 20-year term. But year 21 rolls around, that price is going to go up. After 20 years, you think it's going to go up a little bit or a lot of it? It's going to go up
quite a lot.
Right? Yeah. So, or you got to be cool with moving out, right? So sure. That is term. It is temporary. That's why it's the cheapest, because the likelihood is that the insurance company will not have to pay that claim. This, statistically, you have a pretty good chance if you're, a healthy-ish person, if you're a younger, healthier person, that you're probably going to live for 20 years, barring any sort of accident or, something like that.
Sure.
So most of the time, that's a good bet for them, and it's cheap for you. So it's good that you have the coverage. So if you are part of that small minority of people that something does happen to, your family got a lot of money and you only paid a little bit. So that's term. It's cheap, easy, and for most people, that is a good place to at least start. Now, we tell people to start there, and we kind of caveat it with being like, it may never make sense for you to convert this into something permanent, right? Sure. It might always be the term. But it's nice that you have the coverage, and we have the ability to convert it if that is ever the thing to do. So when you are able to convert it, depending on the company and so on, you're generally either able to convert it into a universal life policy or a whole life policy. Now, again, there's a lot of differences. There's kind of subcategories between those. And then company to company, some of these things can be a little bit different. So I'm going to try to talk about, kind of the bigger picture, broad overview of how these things work.
Okay.
So universal life is, it can be truly permanent, but it has to be like a guaranteed universal life. So in other words, okay, it guarantees you until a certain age or, whatever. So I usually tell people like it's more permanent than term, but it's less permanent than whole life, if that makes sense, because the way that it works, and I'm getting into the weeds just a little bit, but there's like the universal life chassis. So like the core thing that it runs off of, if you will. So the way that it works, and again, making these numbers up for this example, let's say you're paying $100 a month for this policy. Well, that $100 a month, part of it is coming out for cost of insurance and or fees or whatever it might be, right? So let's say that all those costs are $50 a month, but you're paying $100 a month. So that extra $50 goes in this pot, right? Goes in the cash value of the policy. And that pot could work a number of different ways depending on if it's traditional universal life, variable universal life, indexed universal life, some of those subcategories. But anyways, it's being invested however it's being invested. So it could get a fixed guaranteed rate of return. It could be attached to the market in some way, right? But it's going to be getting some sort of return. Well, the next year, let's say, again, you're still paying $100 per month, but now your cost of insurance and fees are $60 a month, and the extra $40 goes in the pot. And then the next year, you're paying $100. The cost of insurance and everything is $70 a month. The extra $30 goes in the pot, right? So you see where I'm going with this. So at some point, you're paying $100 a month, but the cost of insurance and everything else is probably going to be more than $100 per month and will continue to go up. So you're going to have this kind of bell curve of cash value to where, in the beginning years, what you're paying in is more than the cost of insurance. And so it's building that cash value. And then there's going to hit this point where what you pay and what the costs are will kind of even out, and then you're going to reach a point where what you pay is less than the costs, and then the rest will come out of this pot that you've been building up to pay for the rest of that cost of insurance and fees and whatever else. So you're going to have this kind of bell curve of cash value to where your cash value is building, and then at some point it's going to start depleting because that cost of insurance and everything else will continue to go up. So that's why at some point, most universal life policies, or a lot of them, if not properly funded and everything else, will kind of collapse on itself, or it'll kind of eat itself, it'll cannibalize itself, it'll eat up that cash value to where, now there's no cash value and now you have no policy and stuff like that. So we've ran into people that have these old universal life policies that were told, like, this is going to be, you can pay $50 or $100 a month and this is how much cash value you're going to have later and all these things. But then the interest rates changed, or maybe the insurance company changed their cost of insurance on these, which that's the thing about universal life policies that a lot of people don't realize, is that with some of these companies, there's like, little fine print in there where the cost of insurance and stuff that you thought you signed up for, what it illustrates as, they can go in there and change that and increase that cost of insurance on you. And, now the policy doesn't last as long as you thought. So universal life is more permanent than term, not as, I wouldn't call it truly permanent, or at least not in a lot of cases. It can be. But like, let's say you signed up for a $1 million policy and the premium is whatever it is, that $1 million will stay the same, generally speaking, depending on what type of policy that it is. But in other words, that $1 million will stay $1 million. There are certain types where that $1 million, it can grow, but for a lot of times, these are important things to kind of, make sure we're paying attention to. And then again, there's variable universal life, indexed universal life, which are going to be tied to the market in some way most of the time. But, it's just very, very important, I think, for people to understand. I have conversations with people about this fairly often. If you're using universal life as some sort of like retirement planning, like wealth building, I want to build the cash value in here and stuff like that. When you start taking the money out in retirement, right, which is kind of at least part of, let's say in this example, what you have this policy for, that cost of insurance and everything is continuing to go up. That doesn't stop. And those jumps become bigger as you get older. So when you're in your 60s, 70s, 80s, that cost of insurance is on up there and starts kind of really eating into that cash value. So as you start taking that cash value out, which is generally taken as a loan, which will incur some sort of interest, that's the way that you take that money out tax-free. So on top of the loan with interest and the cost of insurance continuing to go up and whatever the fees are and, this and the other, the reason it's taken as a loan is you don't have to pay taxes on a loan. So that's the way kind of around getting, paying taxes on the gains and stuff within the policy.
Sure.
But it's only a loan if the policy is in force. Because if the policy, if you surrendered it or if it cannibalized itself and just kind of, dissipated and went away, well, now all these loans that you've taken that you didn't have to pay taxes on, those gains, again, it's only a loan if there's something to pay the loan back to, so the policy's still in force. So then that policy ceases to exist, and now all those gains that you've taken out throughout the past however many years that you didn't have to pay taxes on, now in that year will all become taxable generally as income, and you will get a nice big fat tax bill. So
that you probably weren't ready for.
You may not have, anyways, so that you certainly were not expecting, but the insurance agent that sold it to you is probably long retired, and, there's, what can you do? So,
sure.
My preference is generally not to use universal life chassis as a wealth building tool if you're trying to use life insurance as a wealth building tool, kind of for that reason. It's just so now again, there are good policies through good companies that you can do that through, but generally speaking, I encourage people to steer clear of that. And then there's whole life. Whole life is maybe not going to be as flashy and sexy as stuff, and again, not to try to get too deep into the weeds, but very important. So whole life is truly permanent in almost all instances, right? So in other words, if you sign up for this policy and you're paying X amount of dollars per month or per year, that amount will not or should not change for the life of the policy. right? So you're locking it in at whatever age and rating and stuff that you are now. Should not change. If you're using it as like a retirement planning, wealth building tool, what have you, very important that you understand the company you're doing it through, because the kind of inner workings, the bells and whistles, if you will, the nuts and bolts of these policies can work a little bit differently company to company. So kind of the mechanisms that make them work can work differently company to company. And it's very important that you have it structured and funded a certain way. So I'll give you, I think it's a story that I think can tell the story better than I can just using examples. So
sure.
We worked with this guy, one of these self-made multimillionaires by the time he was 30, high school dropout, one of those guys, started a business, started working for himself.
Yeah.
Millionaire multiple times over before he was 30, right? So when I met him, he was 31, 32, and he'd been putting in $250,000 a year for the last 4 years since he was 27 into 2 whole life policies through company XYZ, which is a good company, a company that we write through, good company, good product, all the stuff. And so it was like $15 million worth of life insurance, and he puts in $250,000 a year into these 2 policies. And I'm like, all right, well, so as we're looking over things, I was like, all right, what is the purpose of this policy? Is it for succession planning, estate planning? He's a high net worth guy, could be estate planning, stuff like that. I was like, what's the purpose of this? And it's like, no, the life insurance is cool, but really I like the way the cash value works when I use it for retirement planning. I said, all right, well, then let's get some in-force illustrations. I need to look at how this policy is structured and funded and all of that. So we got some in-force illustrations. And the way this policy was built, number one, this policy was built to be paid until age 100. So if he is using it for retirement planning, presumably there will come a point where he will want to stop putting in $250,000 a year into it and start taking money out. Sure. So if it's meant to be paid to age 100, first red flag. Now, with these whole life policies, the way most of them are a part of the way most of them make money is that the insurance company pays dividends into these policies, right? And they could be somewhere between 6 to 8% dividends or something like that get paid into these policies. And so at some point with most of these companies, that dividend will be big enough to pay for the premium. So you could stop paying for it, and now the dividend will go to pay the premium, right? Okay. So that's the case with his policy. So by the time he reaches retirement age, he could stop paying for it, and the policy will pay for itself. Now, as you can imagine, instead of him putting money in and the dividend going in, building that cash value kind of doubly, if he stops putting money in and now that dividend is going to pay the premium, that drastically is going to slow down the growth of that policy, as you can imagine, right? Now, that dividend can either be what's considered direct recognition or non-direct recognition. So what that means is there's going to be a test afterwards, so I expect you to memorize that.
No.
What that means is that with a direct recognition dividend, let's say he has $1 million cash value in this policy, and he's getting a 6 or 7% dividend on $1 million, and he took $500,000 out to use for whatever he wants to use it for. Well, since it's direct recognition, now that dividend goes down to be based off of the $500,000 that remains in the policy. So now he's getting a 6 or 7% dividend on $500,000 instead of the $1 million that was in there.
Yeah.
And then there's companies with non-direct recognition dividends. So same example, he's got $1 million cash value in there. He takes $500,000 out to use for whatever. He continues to get that 6 or 7% dividend on the entire $1 million, even though he's taking money out. So as you can imagine, that doesn't matter while it's building up, but that matters a lot when you start taking money out. So this particular company had a direct recognition dividend. So he's putting money in, he stops putting money in when he reaches retirement age, let's say. The dividend is big enough to pay for the annual premium, so no big deal. It'll continue to grow more slowly, but it'll continue to grow. But now he starts taking money out. So since it's direct recognition dividend, the dividend that he's getting will go down and down and down as he starts taking that money out. So at some point, it's no longer going to be big enough to pay for that annual premium. So now he's either got to start putting money back in and stop taking money out, or the policy will start cannibalizing itself because it'll take that money out of the dividend and the cash value to continue to feed itself.
Sure.
As we talked about earlier, if that policy cannibalizes itself completely, now in his case, the millions of dollars worth of gains that he's taken out of this policy will all become taxable in that year that it collapses, and he will owe a large 6 or 7 figure tax on all that money that he's taken out over the last however many years. So
Sure.
if you are using it for the cash value accumulation, investment component, wealth building component, whatever, very important that the policy is truly paid up at a certain point, ideally before you retire. So in other words, there are policies that you can do to where it's like a 20-year mortgage or something like that, or 15 or 30 or whatever you want. So in other words, at this point, it is truly paid up. There's no more cost of insurance. There's no more premiums. There's no more none of that sort of stuff. It's truly paid up. You don't have to worry about premiums anymore. And now the dividends just continue to go into the policy and, all of that. So that helps as you start taking money out. And then if you do it through a company that has a non-direct recognition dividend, as I mentioned earlier, as you start taking money out, it's not going to shouldn't decrease the amount that you're getting in the dividend because it's based off of basically the highest cash value that was in there. You know what I mean? So super, super important that, again, if that is what you are trying to accomplish, that it is built and structured and funded a certain way. There's another little bit of a wrinkle on that gentleman's policy in particular to where, and I'm just going to brush over this because I'm really getting in the weeds here, but there's what's called a modified endowment contract. So in other words, if you overfund it, if you fund it incorrectly and overfund it without getting into explanation of weeds and stuff like that, it becomes a modified endowment contract, or it MECs, M-E-C, MECs. And now those gains within the policy become taxable. So we've screwed up one of the big advantages of it. So now anytime you take money out of that policy, you're going to pay taxes on the gains, regardless of if it's taken as a loan or whatever else. You're just going to pay taxes. So when we got the in-force illustration from his guy, in bold letters at the top of the illustration, it says this policy will become a modified endowment contract year, whatever. And it was like when he was in his 60s. So not only was the policy itself not serving the purpose that it was meant to serve, or at least not very well, it was funded incorrectly to where right when he starts needing it in his 60s, presumably, all that money that he's put in, all those gains will become taxable, and he's going to have to pay taxes on those gains anyways as he starts taking that money out. So again, and now he'd been having it, so it was him, his business partner, his dad, and I think his brother all had these really large policies through these guys that were all screwed. They were all just terribly, terribly done. These guys were putting in hundreds of thousands of dollars per year into these policies. So I don't know how they got set up with whoever it is that they got set up with, but the guy didn't do as good of a job as you would hope somebody would do. And like I said, these guys would not have found out for decades, and that guy would have probably been long gone by then, right? So
absolutely,
by the time they found out, there's not even anybody to complain to, or no recourse or nothing they can do. So again, super, super important that you make sure if you go that route. So again, conceptually, they're all the same. Whole life is whole life. It's permanent life insurance. It'll build some cash value. The death benefit will grow for the most part, all those things. But the inner workings of them. So the thought process behind whole life and term is opposite. So like with term, you want as much coverage as possible for as little of a premium as possible, because there's no benefits unless you die, right? So you want to pay as little as possible to get as much premium as much death benefit as possible. With whole life, if you're trying to build the cash value, you actually want the opposite. You actually want to be able to put as much into it and have as low of a death benefit as possible, because that reduces your cost of insurance, therefore increasing hopefully the efficiency of the cash value building and so on. So, you hear people all the time. It's like, if they were looking at $1 million 20-year term versus $1 million whole life policy or something like that, they're like, oh my gosh, it's way more. And it's like, well, yeah, but you're just thinking about it the wrong way. If we're trying to get $1 million worth of coverage, then this is a way to do that. But, if we're trying to build cash value, well, then the amount of coverage that you have, not that it's unimportant, but we're just looking at it a totally opposite way than what we're used to looking at it. Right. So, super important. I think that, again, you get the amount that you need. For most people, I think starting with term is appropriate. I couldn't tell you how many times people got sold policies that honestly they didn't need, right? Some of the permanent policies or something like that just, I'm not saying it's not right for them, but maybe the timing isn't right for them based on their financial circumstances or whatever. And we have to kind of, back them out of those things and put them in something else or whatever. But yeah, I hope, and feel free, because sometimes I feel like the math teacher explaining things that like I understand, but so did I, in that, I will say brief explanation, that was long-winded, but where did I leave room for questions as far as how these things work or to consider?
Well, so let me ask, so would it make sense for someone to have a combination of two, probably maybe not all three, but to have a combination of these policies?
Very common, yeah. So again, most of the time, and again, this is just our process, the way that we do things. Most of the time, we'll start people with term, unless it's very specific, like, no, we're trying to, it's more about the asset or the cash value accumulation, less about the life insurance. That's really the only time we would do the, one of the permanent policies. But yeah, so it's not uncommon at all. So let's go back to an example. So let's say that life insurance need that we used as an example kind of at the beginning, and we calculated a $2.7 million life insurance need. Well, this person needs $2.7 million worth of life insurance now because they have young kids that at some point will be off the payroll. They have debt that hopefully at some point, that will be paid off, or they're at least whittling down. And, in 10, 20 years, they're going to have less working and earning years to try to make up for. So in 20 years, their life insurance need is probably less than it will be today in most cases. Yep. For business owners, it can always change because our business value grows, hopefully. And, anyways, there might be other considerations. But for most people, their life insurance need should decrease throughout the years. So, we have the conversation with people. It's like, look, in 20 years, you're probably not going to need $2.7 million worth of life insurance, but you're probably not going to need nothing, right? Mm-hmm. So again, depending on their situation, let's say it makes sense for them to go ahead and convert $500,000 of that policy into something permanent. So now they still have $2.7 million total. $500,000 is permanent. $2.2 million is term. And we can always convert more of that term later if we needed to, or if that made sense to do. But in 20 years, $2.2 million goes away, and now they have $500,000 that will last forever, but they locked it in while they were young and healthy and all the stuff. So that price will remain level then, as opposed to trying to get it. And I hear people all the time, like, let's say with term, like, I'm going to get a 20-year term now, and in 20 years when this one's up, I'll just get another one. It's like, all right, we're making a lot of assumptions, man. You know what I mean? Like, we're assuming that your health is still going to be the same and that you're going to be insurable all. So I'll give you another quick story. I know we're going way past our time. Quick story. Worked with a farmer, 5th generation farmer. He got a 20-year term policy, $5 million 20-year term policy that he got 20 years ago at this point, and it was coming up on the end of his 20 years. And so he was paying, I want to say like $3,500 a year for that policy because he got it when he was in his 30s. He got the best possible rating, all the stuff. Well, now he's 20 years older. So even if he were to still get the best possible rating with that company that he got it through, instead of $3,500 a year, it was going to be like $26,000 per year because now he's in his 50s. Sure. So if he wanted another $5 million 20-year term starting in his mid-50s, last him in his mid-70s, the insurance company's looking at it like, we have a pretty decent chance of paying this out sometime over the next 20 years. You know what I mean? So,
Yeah.
And that was if we got the best possible rating. So we ended up doing some shopping around, this, that, and the other. So the lowest we could find, I want to say it was like $16,000 or $18,000 through this company. And again, that's if he got the best possible rating. Now, so number one, the price difference is shocking to a lot of people because they're 20 years older. And he ended up being completely uninsurable. We checked through over 60 insurance companies. Nobody would cover him. One of the big problems was that he has a CPAP machine, right? He has sleep apnea. He has ordered, prescribed to use a CPAP machine. And one of the underwriters for one of the companies was like, look, if he can print off his thing for a CPAP to prove that he uses this every single night, we'll consider it. It's not going to be a great rating, but we'll consider it. Without that, we can't consider him at all. Wow. And so, of course, he doesn't use it every night, and he can't give us proof that he uses it every night. And so the underwriter was like, look, his blood oxygen levels are such that if he doesn't use it one night, that could be his last night. So we can't insure him for $5 million if he can't prove that he uses it every night. So his options were, if he were to keep that 20-year term, the policy doesn't just go away after 20 years, but the price goes up so dramatically that nobody ever keeps it. So he would go from $3,500 a year, which he's paid every year for 20 years. Now, if he kept that policy, the premium would go up from $3,500 a year to $60,000 per year, and will continue to go up every year after that. So because he's a fifth-generation farmer, and with farmers, a lot of their wealth is tied up in illiquid assets like land and equipment and things like that that are, not easily turned into cash. And he had a rather large estate. So he needed that coverage for estate planning purposes. So now it's like, do we go without the coverage and try to figure out something else? And our family has to sell large swaths of this land to help pay the estate taxes. Or do we pay through the nose for this coverage or something like that? So I just say that to say the idea of, I'm going to get this 10 or 20 year term and another 10 or 20 years, I'll just get another policy at that point, is absolutely possible.
Sure.
It's just not a bet that I would be willing to make, if I'm looking at the financial security of my family.
Absolutely. Well, because you'll never be as young as you are today. Right. And so if only you look at that piece of the puzzle, then that's the part that makes the most sense. And I'm sure there's examples out there of people that got healthier as they aged, but they've got to be few and far between.
Got to be few and far between. And you're just older. So even if you're healthier, so even if you've lost weight, you stopped smoking, whatever, you're just older. So even if you got a better rating strictly because you are older, it's going to be more expensive simply for the fact because you're older. And the way the insurance company looks at it, you're 1 year closer to death, or 10 years or 20 years closer to death, or whatever, right? So, it is very important that, again, you either fully think through all these things or you work with somebody who can hopefully kind of help you think through all of the ins and outs and this, that, and the other to make sure that whatever you get isn't more than what you need. So you're not paying for a policy that, you're paying through the nose for this stuff. Yeah. You need to get what you need, but not too much more, and hopefully not too much less. And, again, generally speaking, I think starting with term is a good place to start, and you can always convert that into something permanent. I say always, most of the time, depending on the policy and the company and so on. Generally speaking, you can convert that into something permanent down the road, and then you can, whether it be a month down the road or 10 years down the road or whatever.
Sure. So, and just like we were talking about our professional dream team, or our dream team of professionals, and the reason for those professionals is you're good at what you're good at, but you need to have someone that specializes in the other things be good at what they're good at. And I think in your example of the self-made millionaire, he thought he knew what he was getting. He's an intelligent guy. He's built what he's built because he's able to understand things and make decisions based on that. But still yet he missed some pretty key parts of that. Right. So, and what I'm hearing
how could he possibly know?
Right. That's not his area of expertise.
Right.
What I'm hearing is the benefit of a fee-based professional versus a commission-based professional is they can take a very, a very objective view of everything, right? To say, hey, this is what I see this as. I don't think it matches with what you see it as, without having any financial interest in the outcome, right? It's just you're paying for the time and the expertise rather than some version of a commission.
Yeah, and I there's a lot of agents and advisors that honestly don't truly understand some of the things that they are selling or helping with clients anyway. So that those doctor clients that I was telling you about, they worked with a lady who has been in the industry 8 years at the time, fully licensed financial advisor, has all the licenses, been working with this specific company that she works for the last 8 years. And so, in the sake of collaboration on their stuff, when we decided they needed more life insurance, whatever, had the phone call with her and just kind of, we talked about some stuff. And I don't remember how we got on the subject. Maybe she brought up whole life or something like that. And frankly, I knew the answers to these questions already, but I said, hey, with this company, are the dividends direct recognition or non-direct recognition? And she was like, what do you mean? And I was like, well, are the dividends that the insurance company pays, they can either be direct or non-direct recognition. So this particular company, are they direct or non-direct? And she's like, oh, you can set it up however you want. You can do it, in a number of different ways. And I was like, well, I didn't say it, but I'm just thinking, what I said was like, oh, that's very interesting. But I was like, well, that is 100% not true. She just didn't, anyways. So, she'd been working with them for 8 years and a fully licensed financial advisor and, all the stuff. And so I say that to say, a lot of these people will know just enough to get excited and sell this thing, but don't know the inner workings and don't have the maybe objectivity or knowledge base or whatever to kind of be like, hey, look, this is how this works, and here's how this fits in here, and here's why you should do it this way, and so on. And clearly that guy that that self-made millionaire worked with either didn't know how these things work and how to structure them or whatever, or just didn't care enough. He just saw a big fat commission. Because I will say I'm jealous of the guy for getting that big fat commission that he got on these enormous policies. You know what I mean? He probably got paid $500,000 in commission on this guy and his 3 other business partners, brothers, dad, whatever. He probably got paid at least $1 million or $500,000 in commission. Just for, writing up his policies, and they were crap policies. He didn't do a good job. So anyways, super important that yes, you work with somebody who you trust them, you trust their integrity, but you also trust their knowledge base and all that.
Yeah. And that you have an understanding of the motivations, right? Is how they're motivated to make decisions or make suggestions or something like that. Now, I work with guys that are very good at what they do. I'm sure there's commissions, but I also understand their motivations, right? And so as long as you go into it knowing that, then that's fine. That's part of the conversation, right? So I don't mean for that to be heard in any sort of negative light. I'm just saying you should understand, or at least have an idea, so that you can go into the conversation armed with that information.
Yeah, I couldn't tell you how many times I've, talked to somebody and they're like, oh, I have a guy or whatever. And, we have some sort of conversation about it. And they're like, I'm like, okay, well, how do you pay him? And they're like, oh, we don't pay him. I'm like, so then how does he get paid? And they're like, oh, yeah, I think the company he works for pays him. I'm like, well, how does it,
yeah.
I just think it's useful. Yeah. I just think it's useful for people to, again, kind of think more than the surface level. And I always tell people, like, look, if you're not paying your planner or advisor for their time and advice, whatever advice they give you has to be something that makes them money, or it's not a business. And I hate to put it that kind of plainly, but you show me how a person gets paid and I'll show you their motivation.
Absolutely. So if someone has more questions, we covered a lot of ground here, and I'm sure there's a lot of questions hanging out there. If someone has more questions, Andrew, how do they reach out to you? If they want to reach out directly with any of the questions, how would they reach you?
Yeah, look, and I'm happy to have conversations with people. I'm happy to review if they already have policies. I'm happy to take a look at them and kind of explain to them this is how this works. It's either great or it's not or whatever. And again, for free, I'm happy to do it for the fence people, right? I mean, we've talked about this before. The fence industry has just really embraced us with open arms, and I love all the folks in the fence industry. It's just what a phenomenal group of folks. But anyways, I say that to say, yeah, I mean, I'm happy to look at your stuff. I'm not going to try to sell you anything. I'm not going to try to, but if it's not great, I'll tell you, and then I'll refer you to somebody who can help you if you need it, or you can go back to your person and explain to them what you want to do or whatever. I don't care, but
Sure.
I'm happy. I think people hopefully would just appreciate, having somebody that an objective third party that can look over their stuff, explain it to them in a way that hopefully they can understand. And then, maybe also explain to them this is either great or it's not, and you should keep it or do something different. And then if I need to refer you to somebody, I can refer you to somebody. But yeah, so I mean, feel free to, our website address is atlasfinancialstrategies.com, or our office phone number is 850-542-4803. You can reach out to the office, ask for a phone call with me. It'll be free. We'll put you on the schedule. Happy to do it.
Perfect. Andrew, I want to say thank you from myself, but also for those watching, for you just being so giving with your time. Anytime there's an ask, you step up and we have the conversation. And I want to tell you, I appreciate that, but I'm sure there's a bunch of people at home that appreciate it as well.
I appreciate that, man. And I'm happy to do it. Like I said, I kind of accidentally found myself in the fence industry, and it's been the biggest blessing for us, man. And just getting to know all the people like you and everybody else that we've got a chance to, to get to know. Just what a great group of folks, man. So if that's all I can do to pay it back, then I'm happy to do that.
Well, so this is like any one of those great relationships. It's a win-win, right? We appreciate you, and it sounds like you appreciate us as well. Win-win all the way around.
Yes, sir.
Well, guys, I hope you got a ton out of this. I know I'm going to have to go back and rewatch this to get all of the gold nuggets out. I've made some notes as I could. You'll want to rewatch it probably 2 or 3 times. If you've got questions, you can always drop them in the comments below, but understand I'm just a fence guy, so probably directing them to Andrew specifically might be a better idea on this subject. But if you do have questions, please don't hesitate to ask. Appreciate you guys watching, as always. Joe Everest, the fence expert, reminding you that good fences make good neighbors,